Here we are today with Marcus, the mortgage guy. Marcus Burton, he's a broker, looking skinny today in that black shirt.
Oh my gosh.
Good work. We are going to talk about the most common loan programs, okay? And it's important to understand the differences, what they are, how they work. And I'm grateful to and excited to do this podcast because it's amazing how people, if they realize and understand the loan programs, the advantages that you have as a buyer, so that it fits your profile the best when you're trying to buy a home.
Correct.
Okay? Mm-hmm. So let's start with the FHA loan. Okay, FHA, what does that mean?
Typically, the FHA loan is a loan that's backed by the government. That's the 3.5% down. Usually an FHA loan, you're going to have a little bit less of a down payment. There are conventional loans that do 3% down, but I like to call the FHA loan the everybody loan. They're not FICO score driven like a conventional loan. The down payment is generally a lot less, 3.5%. And they're a little easier to get. The debt to income on a conventional loan is 50%. That's the max you can go. The debt to income on an FHA loan, if you have a good credit score, let's say over 620, you're probably going to be looking at 56%, 57% I've seen on the back end debt to income ratios. So they allow you a little more leeway for more home buyers to get in with an FHA loan.
Yeah, so the intent with the FHA loan is it's guaranteed by the government so that the bank, who provides the loan, it feels pretty secure. If the government's willing to go down to 620 credit score, right?
Yeah,
you got to have higher credit scores if you're going to do a conventional loan. And there's even programs where you can go down to as low as 500 credit score. You got to have at least 10% down to do that. But it's just more useful, especially if you're trying to partake in the American dream of owning property, okay, that's created and amassed more wealth than anything else in the history of humankind, allowing us to have our own property. Then that's really neat. I think it's been a great program, obviously very beneficial to be able to do an FHA loan, 3.5% down. You mentioned the debt to income. That's phenomenal.
A little
56,
higher.
57.
Yeah. The only thing that people kind of get rubbed wrong, they get rubbed the wrong way about is mortgage insurance. On a conventional loan, mortgage insurance can go away after a certain amount of time.
And that mortgage insurance, to be clear, is based on 20% loan to value.
That's
right?
correct.
So if you're higher than that, okay, your loan is above the 80% threshold, right? Then you're going to have to pay some sort of mortgage insurance.
That's correct. You're going to pay mortgage insurance. And on an FHA, it's permanent until you sell your house or until you refinance.
Refinance it. Okay. Is there anything else on the FHA loan that people should know? A lot of first-time home buyers use it.
Yeah. I just think that they're a little more lenient with co-borrowers. You can do a non-occupant co-borrower. That's someone who doesn't live with you actually, but can be on the loan with you on the purchase contract. I do a lot of loans through FHA where the parents are actually non-occupant co-borrowers that are helping. That even happens on duplexes and even sometimes in triplexes where they do that as well. Help their kids get into a property. They don't have to live with them. But FHA is just an all-around better loan, I think, sometimes for first-time home buyers if they're struggling with down payment or anything else like that.
Yeah, also a gift from a family member.
Also a gift, correct.
Can help as far as the down payment.
That's
can
correct.
be used to get an FHA loan.
100%
helpful.
gift can be the down payment.
Yeah. So another loan program, you touched on it. Let's go to conventional. Okay. What are the key points in a conventional loan?
So conventional loans, that's the loan where it's completely FICO driven. I think that if you're a borrower and you've got an 800 credit score or a 740 credit score, and you've got your 5% down or your 10% down or your 20% down, and you've got assets in the bank, that's what more the conventional loan is geared towards. Someone who's got it a little more together in that way. To get the conventional rates. Conventional also, the mortgage insurance is not permanent. Once your home reaches 78% loan to value,
it drops.
Drops down to 78% loan to value because of payments or principal growth, principal reduction or equity. You basically can petition to have the mortgage insurance removed, which is what I love.
What's the typical price? Obviously, the purchase price of the home, what matters, or the amount of the loan. Say it's a $500,000 loan. Okay, the home was bought for $600,000, $500,000 a loan. What would a buyer expect to see in mortgage insurance?
So mortgage insurance is based on, they do 30%, they do 25% coverage based on how much you put down. The more you put down, the less percent you have to pay.
Gotcha.
But like if you're putting 10% down, I'm thinking on a $500,000 loan, if you're putting 10% down, you're probably about $100, $125 a month in mortgage insurance.
Okay.
A lot of people don't know this. Sometimes people, instead of coming in with a big down payment, sometimes it makes more sense to pay off the mortgage insurance off up front to help them with their debt to income because they're not coming in with as much. When you pay the mortgage insurance off up front, sometimes it's 60 to 70 cents on the dollar. And so you eliminate that mortgage insurance monthly payment. You still have the mortgage insurance to satisfy the lender, but you delete that payment to help you with your debt to income. And sometimes that's enough instead of coming in with 15%, coming in with just a few $1,000s to negate the mortgage insurance, and you still keep a little reserves.
So yeah, no, that's great. So on a conventional, why choose a conventional over an FHA loan?
Because I think conventional is probably just a better loan. I think a lot of people don't like mortgage insurance. The lenders have to have it, obviously. But I think mortgage insurance gets a bad rap, but I also think it allows more people to buy homes.
Because typically on an FHA, the interest rate is lower.
It is
right?
lower.
But I guess it's made
lower.
up for in the mortgage insurance premium.
Correct.
That they'll pay with that.
And a lot of people might not know this, but there's an upfront mortgage insurance premium that's added to the loan when you buy on an FHA. That's 1.75%. And then there's a monthly. So they get you on the price of the home, and they also get you monthly. And that monthly is 0.55 based on the loan amount. So they get you twice.
So it's really customized which loan that you'll allow, that you'll want. Now I will say one of the differences is, and we're seeing a lot more questions on that in this market right now, is what loans are assumable. Okay, FHA is assumable.
It is.
By a future buyer, they can take over your loan. Obviously, if there's been an appreciation, the buyer would have to come with that cash, to close. However, with a conventional, it's not assumable.
Yes, correct.
Right? Assumable meaning, of course, the buyer could take over the loan, that you have. And that does take time for something like that to occur. It's not an instant, typical timeline, while the home's in escrow to be able to close. Is there anything else about the conventional that our viewers should know?
Like I said before, I just think a conventional loan is always the better way to go. It's just if you've got a good FICO score and you've been able to save a little money, I just think it's a better way to go. And ultimately, if you factor in the mortgage insurance, most of the time, the conventional loan payment is going to be about the same as an FHA anyway, even though it's got the lower amount.
I see. So what's a typical FICO score that you're looking for?
On a conventional loan, I'm looking for anywhere between 680 and above. I think when you start doing it in increments of 40, so you go to 720 or 760, I think it gets better. Correct.
It gets better.
Better
in being the interest rate gets better.
That's correct. Interest rates are rewarded on better FICO scores.
And then the last of the most common loans, let's talk about the VA loan.
Okay.
Excellent loan for active duty military. It does require a certificate of eligibility. What are the highlights of that loan?
So a VA loan is obviously for military personnel if they've served, which is great for our country. I love vets and love helping vets get into that. I think it's a great loan for somebody who's put the service into this country. So it's 100% financing. There is an upfront funding fee that they do charge on the loan but they factor it into the loan. You don't have to bring it to close. So it's not cash at close that you're pay for it. They actually put it in the loan, and so you're making the monthly payment on the loan and the fee that they put in there.
Is there mortgage interest or insurance with that?
That's what the fee is for.
Okay.
The fee is
paid up front.
Yeah, it's paid up front.
It's rolled into
Correct.
the loan.
Correct.
Okay, so
that is
that
the
one
mortgage
monthly
insurance.
payment.
Correct.
Amount, and I love helping clients who have been veterans and who have that certificate of eligibility to be able to do that. Can you do a VA loan on more than one property?
You can if your eligibility it's available. You can. I've helped someone that they've paid their home almost off. They had some eligibility left, and they actually bought another home. Yes, you can. You can own two if you have.
What determines that eligibility?
Just the where the equity is in your house, how much you owe on the house, and where that eligibility lands, and how much you have left over. So I've actually, like I said, I've helped someone buy another home with the eligibility that was left over. Typically, most vets sell their house and they get their eligibility restored, and then they go buy another house.
Gotcha.
Typically.
Obviously, the interest rate's lower on a VA loan.
Incrementally.
Okay, than a conventional loan.
Than a conventional.
Very similar to an FHA.
Very similar to FHA.
FHA on that. Again, no money down. It's a great loan. Like a little bit of a difference. I guess the appraisal is a little bit different on a VA loan.
So the appraisal on a VA loan is done by a VA inspector.
Okay.
They work a little slower than most appraisers do.
Not because they're VAs.
No, but
just
they work a little slower. But it's virtually almost the same as an FHA loan, just done by a VA inspector. They've got issues. If they've got issues on an FHA loan, like they would, like you mentioned in another podcast regarding the railing or broken windows or peeling paint or something like that.
They can require those be fixed before funding
That's correct.
the loan.
Yep.
So, as far as caps, an FHA loan, we've gone over 3, right? FHA, conventional, and VA. Is there a cap on the FHA loan amount you can have?
It varies by county.
Okay.
So whatever, if it's Salt Lake County, if it's Utah County, if it's Davis County in Utah, then it's gonna vary by county.
Okay.
And I think working with your loan officer, they'll be able to determine what that is for you.
And then obviously conventional only goes up to a certain amount as well, and then it turns into a jumbo loan.
That's correct.
Usually has a higher interest rate.
That's correct. Anything over $746,000 right now is the current on jumbo loan.
In the loan, right?
On the conventional loan.
So conventional. And then is there a limit on VA loan?
Gosh, I've helped someone refinance a VA up to 1.5 million. So there is a cap. I'm not familiar with what it is because I've never done one more than 1.5 million. But I don't. I think if you're a vet, and I don't know how many vets own a $1.5 million home. This guy did. But generally, if you're a vet looking to purchase a home up to $1 million, there's not going to be a cap.
So all excellent information, and I want to highlight the difference in interest rates, the amount at different levels. So like an $800,000 home, right? If the interest rate is 7%, you'll have your payment. But it's actually, if it's 6.5%, you will be about $265 less per month
on an $800,000 home. That's incredible.
Home. And then it's 500. If you go down another 0.5% to 6%, you'll save $526 a month.
It's crazy,
right? And then let's go to like a $450,000 home, for example. At 7%, say we start there at 6.5%, your payment would be around $150 less. And then at 6%, it would be about $300 less. So that's how much per month it can affect your buying power and what you can afford. Yeah. And obviously, we've talked about different types of other loan programs in another podcast that we've done. But it's critical to recognize how much interest rates affect your purchasing power. And then even let's say we get down to a $250,000 purchase. At 7%, and we go down to 6.5%, that's about $83 per month, and at 6%, it's about $165 per month.
Correct.
Right, and so Marcus, that's great information.
Thank you.
Glad you came on.
Glad I could be here.
I think that it's critical for the masses and people, our viewers, to know and understand that. If you'd like more information, feel free to comment. We'll get you that information right away. And obviously, check out our posts at Layne Sales Utah on Instagram and on Facebook, Layne Thompson Real Estate.